Interest rates are a critical part of any financial decision. Whether you're looking to take out a loan, open a savings account, or invest your money, understanding how interest rates work is essential. In this video, we will cover the basics of interest rates so you can make more informed financial decisions. Keep watching. Interest rates are the cost of borrowing money. Simply put, the amount that lenders charge for allowing a borrower to use their money. In essence, interest rates are the price of credit. And the higher the credit risk an individual or organization is perceived to be, the higher the interest rate they will be charged. Interest rates will vary depending on a variety of factors such as how much money is borrowed, the length of the loan, and the borrower's credit score. Interest rates can also be affected by macroeconomic conditions, with high interest rates tending to occur in times of economic growth and vice versa. When discussing the types of interest rates available, it is important to understand that they typically fall into two main categories: fixed and variable. Fixed interest rates remain the same throughout the loan period, while variable interest rates can go up or go down, depending on economic factors which are beyond your control. A fixed-rate loan is a great option for those who want to keep their finances predictable and secure, as the interest rate will not fluctuate regardless of the market climate. On the other hand, variable rates are beneficial for those who would like the chance to capitalize on a drop in rates if the market turns in its favor. Interest rates are calculated based on an individual's credit history and the amount of money they are borrowing. Generally, people with higher credit scores will get lower interest rates than those with lower scores. Longer-term loans, like mortgages, tend to have lower interest rates than short-term loans, like credit cards. Interest rates are also determined by the type of loan one is taking out and the lender's risk assessment. For example, a loan for a car purchase may have a significantly different rate than taking out a personal loan for debt consolidation. This is due to the risk the lender takes on with each type of loan. A car loan is considered more secure than a personal loan, as the car can be repossessed if the borrower defaults, while a personal loan may require other methods of collateral. The lender will also consider the credit score and financial history of the borrower to determine an appropriate interest rate for a loan. The impact of interest rates on borrowers and savers. Borrowers are impacted by interest rates because the rate affects the cost of borrowing money. For example, when interest rates are high, borrowers must pay more for loans and other forms of debt. When the interest rate drops, creditors are willing to loan money at a lower cost to their borrowers, leading to more attractive loan packages. Interest rates are determined by the Federal Reserve and other economic factors, making it difficult to predict exactly what they will be in the future. Conversely, savers benefit from higher interest rates as they can earn more from savings accounts and other investment vehicles that offer a return on their money. For instance, when interest rates go up, savers can earn more through savings accounts and certificates of deposit. Interest rates are determined by a variety of factors, including economic conditions, inflation, government policy, and the availability of credit. These factors can affect the cost of borrowing money or investing it. Interest rates fluctuate depending on the current situation and the goals of central banks, such as controlling inflation or steering the economy. Low interest rates usually stimulate economic activity, while higher rates can make it more difficult for consumers to borrow and make it more attractive for them to save. Economic conditions tend to have the greatest influence on interest rates as they can affect the demand for credit, which impacts the perceived risk associated with lending. Government policies and regulations of financial institutions also influence interest rates as they can set limits or parameters on how much banks are allowed to lend and at what rate. The availability of credit is a factor as lenders will charge higher interest rates if there is less available credit in the market. It's important to understand the difference between the various types of loan products available, as each product carries its associated interest rate. Interest rates are usually expressed as an annual percentage rate and vary based on the financial institution, loan product, and borrower's credit score. Typically, lower credit scores are associated with higher interest rates, while higher credit scores can qualify for lower interest rates. When shopping around for a loan, borrowers should compare the APR of each loan option to determine which offers the lowest cost of borrowing. The APR of a loan typically includes additional fees in addition to the base interest rate. Borrowers should also calculate the total cost of their repayment schedule to get an accurate understanding of the total amount they will be paying back. Knowing how to use interest rates to your advantage can help you make informed and wise financial decisions. So be sure to take the time to educate yourself to make better decisions with your money. Kindly subscribe to our channel and don't forget to like this video.